Following are the strategies to be used to hedge stock, and we are going to discuss these strategies in detail later during the course. Collar, protective collar. The investor adds a collar to an existing long stock position as a temporary, slightly less than complete hedge against the effects of a possible near-term decline. Covered call by right. This strategy consists of writing a call that is covered by an equivalent long stock position. Covered ratio spread. This strategy profits if the underlying stock moves up to, but not above, the strike price of the short calls. Long ratio put spread. The initial cost to initiate this strategy is rather low and may even earn a credit, but the downside potential is substantial. Protective put married put. This strategy consists of adding a long put position to a long stock position. We would like to thank you for taking the time to watch the videos that we have put together for you today. Take a look and subscribe to our YouTube channel, our Instagram, our Facebook page, and reach out if you have additional questions. We would love to hear from you. Check out our website for more information. Go to www.OptionTradersNetwork.com. Thanks so much.